Tyler Rowe here, everybody, with BitcoinTreasuries.net. I'm here with Soleil of True North. Soleil, can you introduce us to the Bitcoin Treasuries audience?
Yeah, I'm Soleil. My channel's Knight Who Says Knee, and on YouTube and X. And I do the weekly show with the True North crew, and I have my own little daily show called Orange Pill Investor. And I guess that's what got me noticed to be with the True North guys. I kind of just was looking around like, holy crap, what am I doing here with these really savvy investors? But sounds like proof of work really does solve everything.
Cool, man. Yeah. So, of course, we talked to you on the Treasury Orange podcast in Q3 of last year. And what have you been up to lately? What's the options market like with regards to strategy? And are you trading Tesla right now?
Yeah, I have rotated about half the portfolio into Tesla, which makes me sleep a little bit better at night, because when you've got one ticker in your portfolio at like 90% of your port, riding those ups and downs is pretty rough. So November 2024 felt great, and then most of 2025 felt whatever the opposite of great is, kind of bad. And as long as we don't have to go over what my Bitcoin and strategy price predictions were from the last episode, I think I'll be all right.
Awesome, man. So, just to kind of zoom out, I think, with strategy adopting their Bitcoin Treasury strategy, in 2020, 2021, there's been a lot of capital that flew into strategy. You had a lot of retail interest because Bitcoiners were looking, maybe for some extra yield. And as we saw the volatility spike on strategy, I think we saw a lot of options traders such as yourself look at MSTR as a vehicle, to earn some yield and to generate income. And you famously trade options, selling covered calls on strategy and other volatile companies as a business. Can you kind of paint a picture for our audience about why volatility matters when you're selling covered calls and how it can generate yield?
Yeah, so there's an interesting way that a lot of people think about options prices. They think that volatility is good for the options, but it's actually the options prices themselves that drive the calculation for implied volatility. I think a lot of people think, oh, okay, you stick the implied vol in, and if it's high, that means options are expensive. And you stick implied vol in, and if the implied vol is low, that means that options prices are cheap. But it's the exact opposite. You actually plug the options prices into the Black-Scholes model, and it spits out the implied vol. And so what you're really dealing with is, are investors willing to pay an exorbitant price for a long call right now? And the answer has been no. And I think that's been because of the transition from the convertible bonds to the preferreds, and they haven't been able to really build up their leverage ratio. But that's kind of all stuff that I learned kind of after the fact. When I first started trading options, all I cared about was, is the option price high? And generally that's correlated to a high implied vol. And so I would just I would just scroll through Market Chameleon's highest implied vol statistics and spend a couple of hours looking for whatever just paid a ton of premium. And that's what I would sell. So whatever was selling for a ton of premium, I would sell it. And as a Bitcoiner, of course, I had to start paying attention to the company that's just stacking a bunch of Bitcoin. And what I noticed is that they were inheriting Bitcoin's volatility and also their implied volatility. And it just kept the options prices high. Like, even when they would drop from what would be considered high options prices as far as strategy is concerned, it was still way more lucrative than an Apple, right? And especially when Apple started offering a dividend, that was kind of like, for me, it was like, okay, you're out of ideas. If you can't take that money and go and pay someone to come up with a good idea, you're forced to kind of like give it back to the shareholders. I felt like that was kind of like the nail in the coffin for Apple's like ingenuity and new ideas and things like that. And so strategy is coming up with this novel idea of like, hey, let's buy Bitcoin instead of holding cash. They were the first and the bravest to really do that in a meaningful way. And even when Strategy's implied vol was at its bargain basement, it's still delivering way more premiums than most other companies. Every once in a while, you can find something like during the GameStop craziness, you could get tons of premium, but companies like that have tons of risk. Like, you have to get out before the rug gets pulled and things like that. But Strategy has that safe floor because we know it's tied to Bitcoin, which is going up forever. And it's also got that crazy ceiling. So it's just this this kind of perfect storm for an option seller and even an option buyer, which I had to start to dabble into a little bit. Once I saw Quant Bros 1, I was like, holy crap, there's actually a reason not to just sell options. Like I can actually buy them too. And sometimes it works. So yeah, I think it's pretty much business as usual. 2025 did not go well, but we like to say in Bitcoin, you're not wrong, you're just early. And I'm thinking that that's probably the case for 2025.
Yeah, absolutely. That reminds me of a Michael Burry quote from The Big Short where he says, I may be early, but I'm not wrong. And, that's kind of the feeling that I had when I was buying some long duration MSTR LEAPs, which are, long expiration out of the money calls. And as any options traders will know, or anyone who's been paying attention to that market, anyone who bought those LEAPs and held on to them for any meaningful time back from, I would say, the end of 2024 all through 2025 got kind of wrecked. And, Saylor always talks about, Bitcoin maxis, double maxis, triple maxis, and then the degenerates who are porting money into strategy through the derivatives, through the, 3x levered ETFs. And I always was like, oh, those people are so degenerate and kind of idiots. But then I looked at my portfolio, and as I realized how large of a position I had in long duration MSTR LEAPs, because my personal sentiment was so high on the stock, I had had such great returns on my on the common shares, I really piled in an irresponsibly long amount of money into the MSTR LEAPs. And yeah, I held a lot of those to duration, and that part of my portfolio got wrecked. Thank goodness we have Bitcoin as a less volatile backstop. But can you talk about how sentiment on the LEAPs changed, and what was your strategy? Like you said, you sell a lot of covered calls, but added some long calls. What was your strategy, and what did you learn from that whole thing?
Yeah, so since I quit my job in December 2024, I don't have dry powder that comes in from outside sources. So if I want to buy a 1080, I have to create dry powder. And option sellers live in that space of selling options under 60 days. Tasty Trade says that the sweet spot is around 45 days to expiration. So I guess the silver lining is that all of the money that I lost on my 1080s, basically all of that money was generated from selling covered calls in a short time frame. And with 1080s or any LEAPs really, one of the things that I like to say is you have to give yourself enough time to be right. And if you looked at 2024, if you bought in March during that pump, you had to wait 6 to 9 months for the pump in November. And so it kind of seemed like, oh, okay, well, if you buy something a year out, maybe you'll be okay. And then what we saw in 2025 was that when the July pump hit for strategy, you had that one last chance to get out at maybe some profit or break even. And if you didn't, because you thought, oh, it's going to 1,000 and my 1080s are going in the money, we were sadly learning that that was not going to be the case. So you can think, okay, 12 months is enough time to be right, but it might be 18 months. It could be 24 months. It could be, 36 months. And unfortunately, there's, when you want to buy a call, sometimes, 5 years is definitely not available in the options chain. That's just not there. I think most people know the statistic that no one has bought Bitcoin and lost money if they held it for at least 4 or 5 years, but there's no 4 or 5 year DTE long calls to buy. So you're kind of forced to either roll them until you're right or just be okay with the risk right from the very beginning. I mean, I'm guessing that 2026 will be the 2025 that we had hoped for, but we know that eventually it's going up forever, Laura. So we can kind of do that in these Bitcoin Treasury companies with confidence, unlike any other TradFi stock, right? Like Peloton isn't going up forever. Starbucks isn't going up forever. All of these other companies can be disrupted, but a Bitcoin balance sheet can't be disrupted. Other players can join in and, maybe Strive has to pay a little bit more dividends on their preferreds. And so, okay, strategy has the advantage there, but then you can try to distinguish yourself by saying, okay, Strive has a clean balance sheet. They don't have any convertible debt. They're going to be laser focused. You can kind of try to carve your niche, but all of these companies have a vast advantage over 99% of the rest of the market because they are still on zero. As Bitcoiners, we say the number one thing is to get off zero. Just get off zero. And, 99.9% of TradFi is, Bitcoin companies, publicly traded companies are still on zero.
Absolutely. I think, you know, one of my missteps in reading the options market on strategy might have been that, you know, I was expecting more of a, I guess, tightly knit Bitcoin and MSTR correlation. You know, I thought it would be a little bit more neat, obviously day to day, week to week variation, but there was, you know, that we kind of over the summer had that coordinated short selling from Jim Chanos and others. You had a lot of the kind of FUD, I would say, over the MSCI, the Morgan Stanley indices, potentially excluding MSTR. You had the pivot away from the convertible bonds, which I think we both agree was a good decision by Saylor for the long term, but it really did dampen volatility in the near term.
Yeah.
So if you're buying those, especially shorter duration options, but even some of the leaps, it really, really ate into some of that upside. Yeah, I think those are all things that I may have misread, you know, just dabbling in options, I would say kind of more seriously for the first time. And you know, I think that's something that anyone who gets into trading options needs to be aware of, is that, you know, the markets don't behave the way you're going to expect. They don't behave just like anything the way they did over the previous 12 months. You've always got to be nimble and willing to look and pivot to the next thing. So
yeah, that
on our last, go ahead.
Yeah, what you mentioned about that switch from the convertible bonds to the preferreds, it's very important because it's kind of like when your favorite band changes their sound, and you're going to lose half of your old fans, and then you're going to also attract some new fans. And I think that's kind of what happens when a company changes. It was like, okay, there's a bunch of people that were FOMOing into strategy and they liked what they were doing. And now you're going to switch it and you're going to go to this preferred and you're telling me that it's better, but like, if it's not broke, don't fix it kind of thing. Right. So I think there were some people that were happy to just kind of take their profits and go home. And yeah, there's a huge hangover for people who were FOMOing in and kind of lost sight of that low time preference mentality that we're supposed to have as Bitcoiners. Right. And there's probably a bunch of TradFi people that are just trading in strategy and couldn't give a fig about Bitcoin itself, right? They just want to trade something, momentum trade something that's going up. And so there is going to be some hangover as strategy tries to recruit new fans to the new strategy. And, you know, the guys that were fans of what strategy was doing before, maybe some of them come back or maybe they don't. But yeah, I think there's anytime a company has to put money aside for something new, there's going to be that period where you have to prove that it works. And so when they came out and said, this is our iPhone moment, it's cool to say that and it's bullish and we can all get hyped behind it. But then you actually have to prove that it's something that everybody wants, because, everybody thought that their phone was going to beat Apple. And there's even companies that thought they were the next Tesla, right? Nikola came out and was like, oh, you can buy us cheap. We're going to be the next Tesla. And then, the founder was convicted of fraud and that company's not even tradable anymore. So you kind of have to, the market is definitely going to make you prove it. And I think that right now, with the way that Stretch was able to pay their dividend, weather Bitcoin crashing, and crashing is a little bit of an overstatement. Like going up or down $5,000 is not even a big deal. But if it drops 1,000 or two, people call it a crash. But Bitcoin went down and strategy went down, but Stretch didn't. And so I think that's huge. I mean, even with just a few months under its belt and a few months of maturity, it's already demonstrating that they can hold the peg. So I think it's just bullish signals all around.
Absolutely. That's a really cool analogy about the band changing their sound. I like that. I'm gonna have to steal that.
It's all yours.
Great. So you've talked about Stretch holding its peg, past the ex-dividend date, and right now it's paying 11% interest rate. I've got a couple topics I want to dig into specifically on Stretch. Maybe we can talk about, what about when Saylor does have to lower the interest rate on that? But before we get into that, Soleil, do you have any conjectures or theories on where the money and the capital inflows are coming from on Stretch to kind of hold this peg right now? Do you think it's retail demand? Do you think hedge funds are piling in? Do you think traders are keeping it there? Was Saylor's tour of the Middle East successful, and you think we might see some of that sweet sovereign wealth money come in from the Middle East? What are you thinking there?
Yeah, I think it could be a little bit of a combination of all of the above, but what I think the only thing that I can say speculate for certain, I suppose, is that initially there were people who were buying it below par that were happy to just ride it up to par and then maybe collect one dividend and, okay, scoot on to the next thing. And there are also people who were maybe stashing it as dry powder. And then when we did get a Bitcoin dip, it was like, oh, okay, well, this was the point, right? I was going to hold this in a cash that paid a yield instead of a melting ice cube. And you know what? I'll sell this to go and load up on some sats. And I think all of those things are valid plays, but those people are probably gone, right? So those are the guys that are going to jump in and out of a trade. And so the new buyers, whether they're retail or whether they're institutions, are not thinking in that way. These are the people who are going to probably leave it there. And instead of taking their dividend and selling, they're going to take the dividend and do a drip and reinvest those maybe in more of the preferreds. Or I know that when I look at people commenting, there are so many different ways that people are doing this. Some people are loading into the preferreds and using the dividends to buy Bitcoin. There are people who are buying the preferreds and using the dividends to buy more preferreds. They're using the dividends to buy more strategy. They're using the dividends to do tons of different things. And there's a TradFi option seller that I'm friends with, and she posted something about, hey, I've got like 93 grand in my emergency fund and it pays 3% high yield savings. And I'm like, holy crap, that's terrible. And when Stretch first came out, it was a risky proposition because, okay, it pumped up to 99, but then it dropped to 92 or whatever it did. And that's not stable savings. But now if it's going to hold the peg and it does that and proves it can do that over a long period of time, those people would actually have to be crazy to leave their emergency fund in a 3% yield. So the fact that the money is coming in from somewhere is not surprising. And I don't know if it's whales or fish or whatever, but when a product is 3 times better than anything else other people can get, it's going to attract attention. So the other thing is that even though it gives us a little bit of heartburn as Bitcoiners, like, oh, okay, they ATM'd to buy cash. If you can call me a deluded fanboy, but if I want to make an excuse for it, I have to look at, okay, they bought some cash, but it's going to allow them to sell more preferreds and to sell more preferreds to a larger market. And they're going to use that as leverage to get better ratings from S&P. And then that's going to allow them to sell even more. And I think what I initially thought about Stretch will probably end up taking place was, as soon as it came out, I thought there's no way they're going to be able to keep this under the 101. I'm like, they're just going to be like having to ATM the ever living crap out of this. And then when it got up to 99 and dropped to 90 something or low 90s, I was like, oh, I guess I was wrong. But I think that actually is the problem that they're going to have to contend with. And this most recent buy was eye-popping. But then when you looked at it, you're like, well, wait a minute, 300 million was Stretch, but the other 1.8, 1.9 billion was the common. And I thought, man, you missed out on a golden opportunity to just flex Stretch with no common, because that would be one hell of a narrative to send to the market of like, we could, 300 mil a week for 50 weeks is 15 billion. Like we can load up 15 billion worth of leverage with no common. And that was actually short-sighted on my part, because what I didn't realize is if they did that, they would blow their amplification ratio way past safe levels. So they actually have to ATM some of the common just to make sure that they have a responsible amount of leverage. And
you're saying with that one buy, or if they just kept hammering?
No, period. They're going to have to keep doing it. Yeah, they're going to have to keep hammering the common at really any MNAV. If they want to keep hammering the preferred ATMs, they can't just do that, because their amplification would get out of whack. And the whole pitch at the beginning has been, hey, look, the only way to beat Bitcoin is to leverage Bitcoin. And so as individual Bitcoiners, we can go and lever up. But if we lever up irresponsibly and we get liquidated on move from 95 to 90, then we're kind of screwed. But a company like Strategy can lever up and their Bitcoin is not encumbered. So they can weather these ups and downs, and it really just means nothing to them. So people ask, why would anybody pay a premium for Strategy? And that's one good reason there, is that they can do the leverage in a safe way that I can't necessarily do as an individual. And some people don't want to learn how to do that crap anyway, right? I'm an options trader, so I can go in there and, you know what, I don't even want to say IBIT because screw BlackRock, but like what's the ARC one? ARC B?
Yes.
Yeah, let's just say ARC B, right? Kathy Woods seems like a nicer person than Evil BlackRock. So we'll say ARC B, right? I can go into ARC B and I can find a leaps and I can buy double X leverage on Bitcoin, but I have to choose an expiration date. I have to monitor it. I have to figure out when I want to exit my position. And if you're not a sophisticated option trader and don't want to be one, you can just buy some strategy, hold it for 5 years. It has no expiration date. You can do the dead man's portfolio and just close your eyes and wake up in 5 years. And as long as they haven't leveraged themselves irresponsibly, then you can just let them handle the hard part. And so their whole pitch is that we're going to leverage Bitcoin responsibly. And if they just hammered the stretch ATM and didn't balance that and keep it in the proper ratio with the common, then that wouldn't be stacking sats responsibly. So my initial reaction to that was short-sighted. And I kind of was like half thinking, oh, well, maybe they have to do this to keep the amount of Bitcoin collateral up to a certain amount in order to justify more Bitcoin, or excuse me, more stretch ATM. And that was like barely correct. And when I saw Dan interviewed about it on One Chair, he actually explained it much better, and it was very detailed. And I was like, oh, okay, I get it. They would have actually blown through their what would have been a safe amplification ratio if they just ATM stretch to the tune of 15 billion in 2026 and not ATM to the common because people are pissed off and they want us to let the price run. Then they would end up actually having way too heavy of leverage. And so this should be expected. There's going to be some perfect ratio of common ATM to preferreds, even though we would love to see 0 common ATM and 100% preferred, but that's just not sustainable forever. They're figuring it out too. And that was another thing that Dan said is we give them a little bit too much credit for knowing things that we don't. But like, this is so new. They're kind of figuring this out as they go. And we're like trying to figure them out, figuring themselves out as they go. And so it's a lot of fun. And, just a few years ago, I had no idea that I would be doing this. It's kind of a crazy change in my lifestyle.
Cool. Yeah, that's good commentary. And we're glad you are commentating on this stuff. I've learned a lot from you, Soleil, and the whole True North crew. I can't really blame Saylor when we look at that recent buy he had where he did hammer, multi-billions on the common in addition to stretch, because I think it was their biggest Bitcoin buy that they've ever had, if I'm correct. And, as Bitcoiners,
yeah,
we see the price and, maybe we always think this, but Bitcoin is really on sale right now, right? As of recording or when Saylor made the buy, it was around $90,000, right? So are you happy with the leverage ratio that they're at currently? I think we saw them spin up to what, close to, he's always talked about 20 to 30% when he was doing the convertible options. And I think they're still in the low 20s, if I'm not mistaken. What do you think is the right leverage ratio?
Well, they've said that they can go up to 50. And because the preferreds is a much safer way to stack. So if they ever get to 50, that would be pretty cool. And even the 1x MNAV bears, like if they traded at 0.9 MNAV forever, like if they literally were getting their Bitcoin discounted and the business intelligence software was worth 0, then trading at, 1.3 or 1.4, 1.5 would still let them outperform Bitcoin. So to a certain extent, as long as they don't get wrecked and their Bitcoin's not encumbered, so it would be an extremely prolonged bear market that would take, I think the 4-year cycle idea is dead and gone. Like, I don't know if anybody even still believes that anymore, but 8 to 12 years went by of like just a ginormous, insane bear market. Like maybe it would take something like that, but they've already said that they can pay the dividends with their cash reserve now for what? Several years. Yeah. And I go off on tangents a lot of times. What the heck was even the question? What are we talking about?
Yeah, no, I think you touched on it. And I think what we often miss is that Saylor has been through an 80% bear market already in Bitcoin through the, 2022 cycle. And capital markets were still open to him. He didn't get as favorable terms. Certainly, he had to take on some more traditional debt or bonds that had a little bit of a higher interest rate, but he still was able to raise with converts. So, a lot of us lament the end of the convertible bond era where there was, just massive volatility. But, those could come back in a bear market scenario. And when I think of what Bitcoin hit for an all-time all-time high in October. We were at about 125, 126,000. So even an 80% drawdown from there, that would be a Bitcoin price, if my math is right, of like 25,000, 26,000 a coin.
Mm-hmm.
And if we're looking at that, that's only a 250 billion market cap for Bitcoin. We're never going back there, are we? Right? I'm buying all the coins I can, and a lot of my network are buying all the Bitcoin they can, at that price. And I just, Bitcoin does things we don't expect, but like to see a major drawdown from 90,000 just seems really out of the realm of possibility. What do you think about, capital markets being open, if Bitcoin does enter that prolonged bear market, like you said?
Yeah. So, thinking about what's the lowest it could go, I mean, some of those numbers sound extreme, but Bitcoin can literally just do whatever it wants. And not everyone is trading with leverage responsibly, right? So strategy is, and they can weather these things, but all the degens are getting wrecked on a Sunday night with 50x leverage. And if some of the institutional players think that they can spread their fractional reserve shenanigans into the Bitcoin market, that's not necessarily going to work out in the same way, because they can't just print more Bitcoin out of thin air like they can go and get kind of saved by the bell and saved by the Fed. So could a bunch of leverage unravel combined with some other kind of market black swan and get us sub 50 again? It can totally happen. I said in my final thoughts last night that with respect to short-term price action, there's two kinds of people. One is people that don't know what the price will do, and there are people who don't know that they don't know. So we can speculate all we want, but over 4, 5, 10 years, we know it's going up. Over 3, 6, 9, 12 months, 24 months, it's much less certain. And so, I don't even use technical analysis, but the most of that I'll do is draw support and resistance lines on a chart. And when you look at it that way, it's way scarier because, if you draw support at 80 grand right now and it crashes below that support, the next support below that is 60, 65. So it can, that's just dropping one support level. So to get to 50 would just be one panic below, a single panic. And so those things are definitely, on the table, and they can happen, which is why the options sellers, when people talk about options in general, it sounds risky, but that's the option buyer side. The option sellers are actually reducing risk. And so every time I sell a covered call on strategy, or I sell a cash secured put on strategy, or any of the miners or Tesla, whatever, you're actually reducing your cost basis. And it's not like an easy mode I win button, right? It's only lowering your cost basis by 1% here, maybe 2% there. But if you lower your cost basis by 1% and you do it 100 times, well, now the stock's free. You've paid for the entire thing, and now it's all house money. That's an extreme example. It would be very difficult to sell 100 covered calls in a row without getting something called away. But just zooming out in a general philosophy, that's kind of how I look at it. And some people say, well, if Bitcoin is going up, and then that means that these treasury companies are also going up, why would you ever limit your upside? And I think the answer is that when you hold Bitcoin, you know that you control your keys. It's a sovereign asset. As soon as you go into a derivative, now you have third-party risk. You've got key man risk. You got Elon, you got Saylor. Those two people cannot be replaced because of the charisma and just the online following and the hype and the memes and all of that stuff. And it's not that I don't think that the other executives aren't competent. I have no qualms whatsoever that Fong Li and Andrew Kang can't execute. They absolutely can. But are they going to have, deluded fanboys like myself just memeing every public appearance that they make? So I think it's perfectly reasonable, even though I think that strategy will outperform Bitcoin over 5, 10, 20 years before we have to kind of make a decision on what to do in the future when the bond market has been completely drained of money. I think it's perfectly reasonable to say, you know what, I'm taking third-party risk with a stock, so I'm willing to limit my upside and sell some portion of that position. It doesn't have to be 100%, like I do for most of the time. But, if you got 1,000 shares and you want to sell covered calls on a portion to fund your lifestyle, or to fund some degenerate 1080 purchases, or to fund, buying shares of something else, whatever it is, or if you just want to reduce your cost basis for an increased chance of success, I think it's perfectly reasonable to do that because of that inherent additional risk that stocks have that Bitcoin simply doesn't.
Yeah, that makes sense. In our last conversation, we talked about, how selling covered calls really isn't a short position on a stock, especially the way you do it. You've got a long thesis. Can you talk a little bit about that and refresh our viewers about how doing what you're doing, you have to have conviction in the underlying?
Yeah, sure. And I don't bristle at being called an options trader, but some people call that, kind of take that as an insult because investors have low time preference and traders have high time preference. But this is actually more of a long-term strategy, and it's not day trading. It's more like serial, weekly or monthly iterations of a single strategy. And over years and decades, those small aggregated wins should amount to returns that, they better the old hurdle rate used to be the S&P 500. So it better do better than that. That was kind of my original hurdle rate. But now you actually have Bitcoin as the hurdle rate. So if it doesn't produce returns greater than Bitcoin, then it will have been a waste of time. But the point is to, instead of trying to hit home runs, you're trying to take a little bit of premium. It could be 0.5%, it could be 1%, weekly, and let those wins add up over time. And once your account gets to a certain size, right? Like let's just say that you're collecting 1% per week, which would be outstanding, obviously. But for easy math purposes, if you did that for a year, that would add up to 52%. But if you take the 1% profit and you're able to buy another 100 shares of something and get another 1%, now you have you've changed your returns from an additive, right? It's not 52% a year anymore. It's 1% times 1.01. And if you add that up over 52 weeks, it ends up being like a 67% return. So the point is kind of trying to get your account size up to a size where every time you collect your premium, you're able to buy another 100 shares of something and then turn it into an exponential return. And I call that reaching critical mass. And you could do it with a little bit smaller of an account if you're willing to trade cheaper stocks. But with options, you have to be able to squeeze some premium out of that position. And if you get too far under a $10 a share, it just starts getting really difficult. Like I did stack a few shares of Strive, but at sub $1 a share, even going out 45 to 60 days, you can get maybe a nickel or something of premium. And it's very just kind of hard to squeeze blood out of that size of a position. So if we try to reverse engineer how big of an account size it would probably be something around at least $10 a share, I think would be somewhat safe to be able to squeeze some meaningful premium out of. So if you have to be able to collect $1,000, because $10 a share times 100 shares is about $1,000, then you would have to be able to collect about $1,000 in premium. And if you divide that by 0.01, you actually would probably have to have a portfolio size of about $100,000 in order to start reaching critical mass types of returns, right? You collect $1,000 of premium, you take that $1,000, you buy 100 shares of something that costs $10, maybe a cheap mining stock, and you start adding 100 shares per week of a new position. And that's when the gains really start to multiply. And at that point, kind of doesn't really matter if the underlying price goes up or down, because as long as you didn't pick a complete dog and it goes to zero, then it recovers and you're not ever completely wiped out. So reaching that account size, I think, is probably the goal to get to. And beyond that, everything just kind of opens up wide. So it's a very long-term strategy, but with high frequency trading inside of it.
What I'm hearing at the end of the day is that you're really excited about the Strive 20-to-1 reverse split that's going to be happening soon, right?
I am.
It's going to get them, I think, to $15 to $20 a share.
Yeah, exactly. It's going to put it in the sweet spot for an option seller because, right now it's so hard to squeeze a few pennies out of that thing. I know there's poor sentiment around reverse stock splits, but hopefully this will make it a sweeter deal for the options traders. Now, on a small account, you kind of get screwed. Like I started a 5K account to try to demonstrate the techniques, for, hey, can I sell options if I've only got $5,000? And in that account, I've got like, I don't know, 1 or 200 shares of Strive, right? But when it does a reverse split, my 100 shares is going to be 5 shares. And you can't sell a covered call on 5 shares. So in that sense, it will price itself out for option selling if you're on a small budget. But I think in the long run, I am licking my chops to be able to generate meaningful premium on their stock position without having to worry about if it goes down 50%, am I now, stuck bag holding? So yeah, it is bullish as an option seller.
Yeah, it's funny. Just a bit of a lighthearted note. My daughter started a brokerage account this past year, a kid's brokerage account where she kind of manages the buys and sells. And I haven't had the heart to
Really?
tell her. I haven't had the heart to tell her that a reverse split is coming for Strive. So her account balance won't meaningfully change, but she's going to see her share count diminish.
Right.
And I'm just punting that conversation until she notices. But
yeah, her pizza is
yeah.
being cut into less slices instead of more slices.
Yeah, absolutely. Now, when we think of the entire Bitcoin Treasury company landscape, the options markets are, still in early days for most of these companies because they don't have anywhere near the volume that Strategy does. Even the top companies I'm thinking of, 21 and Strive and others. How do you manage looking at selling or buying options on an options market that isn't as robust as Strategies?
It's the number one thing that you should be worried about. Well, you could call it number two. You can say that position size or liquidity is number one and number two, and I won't fault you if you put either one in whichever order, but it's very easy to buy something. And even if you win that bet, it can be a lot harder to sell it. So, if you're looking at a ticker and you're like, you know what, I know this thing is going to 10x, so I'm going to buy some calls. And then you start looking at its volume and it's like no volume and 10 open interest. Well, okay, say you're going to be able to find someone, the market makers will sell you that thing if you want to buy it. But let's say that you're correct about that 10x and you're like, okay, cool. Now my option that I bought for $1 is worth $500. I want my money. If you go to the market and no one's willing to buy it back from you, then you're just stuck with it. And maybe, if it's a LEAPs and you got to hold it for another 12 months and the price hasn't gone down, then maybe you can exercise it, or, by then the price might come back down to earth and you've kind of missed out on your window of opportunity. So liquidity is extremely important. And, I think there was, I've been listening to some of the silver short squeeze talk, and this his point was, look, you can go to freaking Costco or wherever and buy a gold bar, but now what? If it goes up double in price, Costco's not going to buy it back from you. Where are you going to go? You're going to have to go to some metal shop, and those people do not just take the spot price.
Right.
If the spot price for silver is 90, the local shop's, maybe going to give you 80. So liquidity is king, and you have to be very careful not to enter into these positions in companies that you just know is going to hit a home run. If you can't exit when you win, that doesn't do you any good.
Yeah, I think that's part of the beauty of the equitization of Bitcoin generally, as we've seen the rise of Bitcoin Treasury companies, is that you can get exposure to a hard money asset, especially if you're someone maybe who's not even a Bitcoiner, but you're at least aware of the melting ice cube that is, the US dollar and other fiat currencies. I think, being able to access equities that have liquidity is so much different than going and buying gold, right? Because the best you can do to get spot gold prices is to buy GLD, the gold ETF, which at the end of the day, people realize is just paper gold, right?
Yeah.
Yes, equities are in a sense a form of paper Bitcoin, but there's also, the operating company element, the belief in the management team, and I consider them more backed by Bitcoin than just, a promise to deliver Bitcoin. It's something entirely different than buying and selling the bearer instrument that is Bitcoin. I think that's something that's a little bit undersold. And I don't know if you saw the What Bitcoin Did podcast that Danny had with Saylor recently.
Oh, yeah.
And obviously it was really contentious. We're recording on January 22nd, and that came out this past week. But, Saylor was really critical of, Bitcoiners who kind of ignore equities and ignore what Bitcoin Treasuries are doing and maybe poo-poo it and are bearish on the strategy because they've got kind of an idealistic mindset, which, I certainly came to Bitcoin because of the idealism and because of my disbelief in the, perpetual nature of fiat currency. And I do view Bitcoin as a freedom asset, but, I think Saylor, really did change the conversation among Bitcoiners in how the rest of the world, the corporate world, looks at Bitcoin. And I think it is a bit counterproductive to have Bitcoiners out here just criticizing the Treasury strategy. I think it's important that markets do point out scams, because every company doing the Bitcoin Treasury strategy isn't going to execute the way Saylor has. Some are punting it, but a key point that Saylor made was that, what better thing could you do for your company, for your personal, your corporate balance sheet than to buy Bitcoin? And, that kind of really resonated with me because, I think even though I'm really bullish on Bitcoin Treasuries and the strategy in general, I did share some of Danny's position, that we do want to make sure that owning self-custody Bitcoin is the first thing someone does, and that, scams are still scams. But what Saylor said really resonated in that, you can't blame anyone for incorporating Bitcoin under their balance sheet, and you don't have to buy it. The responsibility to do your own research happens when you're an equity investor, when you're a speculator, when you're an options trader, when you're an analyst. You have to do your own research, and ultimately, at the end of the day, you have to look yourself in the mirror, and you've got no one to blame but yourself for the purchases you make. What did you think about that think and Saylor's comments?
Well, what an ignorant and myopic question, Tyler. Why would you ask me that? Yeah, man, he was on fire. And I think Danny was very surprised that Saylor was insulted. But if you look at it, I mean, what's he really saying? He's saying, but why should I invest in a pure play? Well, if Bitcoin is the best thing that you can buy and someone is hyper focused on it, where's the criticism? Like, what are you even talking about? Now, I do agree that the 1x MNAV bears are kind of technically correct over 10, 20, 30 years, that MNAVs will trend to 1x MNAV, but that's true for every company, including the ones that have no Bitcoin. So if you have no Bitcoin, your MNAV is trending to zero, meaning your company will be absolutely worthless because anyone who owns Bitcoin will become fabulously valuable, and everyone who doesn't will be worth nothing. I know there's some people that think that fiat will live forever. I don't know. I guess I'm a hyper Bitcoinization person, so I would differ from Saylor on that, even though it sounds like he cheerleads it to a certain extent, but I don't know. I don't know if he just can't put the fear of God in some of these big institutions that fiat is going away. But, to a certain extent, if you're saying pure play has no value, then you're kind of insulting his company. And if you're saying that companies that don't have positive cash flow are bad companies, he kind of almost tricked Saylor into agreeing to that with like, well, why would you buy a bad company? But Strategy's company originally was a zombie company. They had amassed $500 million of a melting ice cube and didn't know what to do with it, right? They knew they were never going to beat Microsoft. So he's told that story a freaking 100 times of, do I want a fast death or a slow death? And I think he could have actually taken it much farther than he did. Some people are saying, oh, he took it too far. I think he could have taken a step farther and said, look, companies that don't have positive cash flow might only be bad companies because the fiat system is inflating the ever-living crap out of everything. So is it really fair to say that a company that's trying very hard and doing all the right things isn't making money in a rigged system? It doesn't necessarily make them a bad company. And so I think Michael got his back up against the wall because it was kind of like Danny was giving them a free pass for being first and being the biggest, but then kind of get a subtle jab in there of, but what about everyone else that's copying you and doing exactly what you're doing? Surely they all can't win too, right? Like you're the only one that's going to get away with this. And so I think, yeah, Danny probably shouldn't have been as surprised as he was about how kind of insulting that question actually was if you look at it, because, it was kind of framed as like, hey, I'm not criticizing you, but what about all these other companies that are just doing what you're doing? Like they suck, right? So yeah, it was one heck of an interview, and should he have been a little bit more gracious? Potentially, there can be people that are turned off by that, but it also was kind of a shot across the bow of like, look, man, if you don't have valid criticism other than just these low energy takes, like don't come to me with a half-baked question that you ask everyone that you haven't really considered and weighed carefully. So maybe he'll get better interviews in the future because people will be much more prepared and not willing to just ask any old question without thinking twice.
Yeah, and I have no doubt that Saylor listens to what Bitcoin did. He's consumed all the podcasts. He read the Bitcoin Standard. I don't question his deep understanding of the problems with fiat and the proposition of Bitcoin. He's just kind of taking a different attack vector, right? The corporate, the Wall Street play, and he's trying to siphon as much capital into his company, which is buying Bitcoin, which is the best strategy if you've got a business, right? Any of us who has a business, the goal is to accumulate as much wealth as possible while providing a service, and we're convicted that the way to do that is to accumulate more Bitcoin. And yeah, I do think he took it kind of as a personal slight, and I think there was some built up frustration because of some of the chatter that's been going on over the last 6, 7, 8 months in the Bitcoin space, the Bitcoin podcast space, for people who are maybe not as bullish on the Treasury strategy. And we'll see. It's a free market. We're going to see where this all goes. We're going to see which Bitcoin Treasury companies succeed, and whether it's pure play, so-called, or not. I can't fault anyone for adding Bitcoin to their balance sheet. And I think my position too has evolved on that. I'm trying to profile as many companies as possible and talk to as many executives and really wrap my mind around what they're doing with their Bitcoin strategy, because there's lots of different flavors of it. So yeah, I think it's all good for the larger Bitcoin ecosystem. Just one question, just stepping back onto Stretch, if we can for a second, Soleil, and then maybe we'll wrap this up here soon. But right now, like I said, Stretch's dividend is at about 11%. They're holding the peg close to $100, which is allowing Saylor to tap that ATM. The theory is, as interest rates on fiat or by central banks are reduced, or money markets go down in the yield that they can provide, Saylor should theoretically be able to reduce the dividend on Stretch. But given that we saw Stretch lose its peg or go from 99 to 92 in short order when there was low sentiment on the strategy common stock, do you think he's going to have an easy time of reducing the dividend as interest rates fall, or is that something time will tell, or is he stuck in this pattern of having to raise it when the peg might falter? What do you think about that?
Well, they've got pretty strict guidance on that. So they showed it on the show last night that if it goes above 101, then they can recommend a lower interest rate. So if they're able to hammer the ATM and keep it between 1 and 101, then they can just leave the rate where it is. So when it first came out, I thought, man, they're going to have a hard time keeping this under 101. They're going to have to lower the interest rate. That's what I was immediately thinking. But anything that's new that comes out has to kind of mature a little bit. So I got a little bit overzealous there, but I think, again, maybe I wasn't wrong. I was just early. I think they're going to have a hard time keeping it under 101 at some point. And if it does go over, but who the hell is buying it? I don't know who's buying it at 150 cents. Who's buying it at, who's doing that? But I guess people who are starved for yield, and 11% is like, we talked about my friend earlier, like 11 is almost 4x better than 3%. So there's going to be demand for this thing. And if they can't keep it under 101, they'll have to lower the interest rate. There's just kind of no other way around it, because they can't just ATM more than they can stomach, because their amplification ratio will get out of whack. They're actually, I think they're beyond schedule to blow through, if they did 300 million a week, I think they've only got about 10 weeks left of ATM money. So on February 5th, at the earnings call, they're probably going to have to announce a new ATM, and it's going to be huge, both for the preferreds and the common. And it's, it's going to be interesting to see how the market reacts to that. But yeah, it's, if they can't keep it under 101, they'll lower the interest rate. I think it's that simple. And then if if they lose the peg, then they've got next month to correct it. And I think that the volatility is going to be much, much smaller from now on, based on what we kind of talked about earlier, is that the new buyers are not just arbing it from 95 to 100 and then just want to go find something exciting to do. I think that the people who are buying it now, there's some people that are actually kind of like, well, I almost said hot racking. That's a Navy term for when two people actually share the same bed because they're on opposite watches. So you have a 12-hour shift and then you go wake up another guy, he goes to work, and then you like go sleep in that bed. It's called hot racking. But people are hot racking SATA and Stretch to get both dividends. I don't really know if this is working, and it seems like a pain in the ass and a lot to do. And you'd have to make sure that it didn't lose the peg so that you lose money. A lot of times dividends will pay out and then drop by the amount of the dividend. And so I was worried that was going to happen. But in these preferreds, there's really no reason why the stock price should crash after a dividend, because you're not paying the dividend from the preferred. You're technically paying the dividend from the common. So if anything, when Stretch pays a dividend, Strategy should drop by the amount of the dividend, not Stretch. When Apple pays a dividend, they're actually paying out cash from their company. And so it's natural that their share price should collapse by the amount of dividend. But the preferreds is a little bit different. So there's really no reason why paying the dividend should cause them to lose the peg. And I think the volatility is just going to be very minimal from here on out.
I hope you're right. And I've got to wrap my brain around that a little bit more about, the dividend kind of hitting the common. That makes sense intuitively. And I'm excited to see what happens with that moving forward, And I agree with you, Soleil. There's just going to be so much demand for this product. I'm in my personal life, anyone who's like not a Bitcoiner but has some cash laying around looking for yield, has it parked in money markets. I'm like, yo, you've got to stuff some money into Stretch. All you have to do is believe this company with a huge balance sheet isn't going to go belly up and they're going to be able to pay these dividends. Here's the cash they have on hand,
Mm-hmm.
And I share an anecdote with I got a friend who's a financial advisor. I talked with him recently. He's talking about there's $8 trillion right now in money markets in the US, and that's like an all-time high. And
Wow.
As we know, yields are shrinking, and he's managing, a 9-figure portfolio. He works for a top 10 financial advisor firm, and he's a Bitcoiner, but he can't allocate any of his clients into Stretch. And I asked him, I was like,
Really?
what's the chain of command to be able to offer a new product, through your broker? And he said, oh, it's easy. You get with a client who wants a certain product, put in a request, and you make it happen. And usually in short order, you get the green light as long as there's no red flags on it. And I was like, well, then why aren't you doing that? Why aren't you just like, he says he's got tens of millions of dollars of client funds that he would love to put in Stretch or any of those products. And he's like, yeah, but I'm making a really good salary. He's making a couple $100,000 a year probably on his assets, and he doesn't want to rock the boat. He doesn't want to be known as, he doesn't want to get flagged by the broker as I'm a crypto guy, right? There still is like this kind of fear of being first, right? Or this fear of rocking the boat, or this fear of being someone who thinks about things in a non-traditional way, especially when you're killing it. You're providing service to your clients, and you've got a stable income stream, and it's like you want to do even better for your clients, but you can't, because, we thought Larry Fink and BlackRock launching their ETF was going to change the game, and maybe it will, right, eventually. But there's still a lot of education that needs to run in the Bitcoin ecosystem, and even these Bitcoin derivatives and Bitcoin companies. So I think we can kind of call it there. And, I think we've got a lot of runway, and that makes me bullish on Bitcoin in the coming years, and how we're going to see more money flow into Bitcoin, and that perpetual bid on Bitcoin from companies like Strategy who have these preferred equities. So Soleil, thanks for stopping in and joining the Bitcoin Treasuries podcast. Tell everyone where they can find you online, talk about your stream and your X handle.
Yeah, on X, I'm at Knight Who Says Knee. Actually, I just started posting on Nostr as well. I'm hoping Nostr really develops. They don't target you with the algorithm, so it's naturally less of a dopamine hit than X is, which is trying to push you into all kinds of addictive directions. But you can find me on X, on YouTube, on Nostr, on my channel Orange Pill Investor, and on the True North, of course, every Wednesday.
Great. Thanks for joining, man.
Thanks, Tyler. It was awesome.